Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. I'm recording this on Thursday, the 27th of August, and I'm delighted to be joined here by Anastasia Amoroso, who is Managing Director and Chief Investment Strategist at Partners Group. She's also a well-known face on Bloomberg, CNBC, Fox News. Welcome, Anastasia. Great to have you here.
Thanks so much, Ethan. Good to see you. Good to be with you.
Well, with no further ado, let me bring up the slides. Well, I've called today's podcast Defying Expectations because this week we did lose Dolly Parton, and the picture here is of childhood literacy. That was clearly something close to her heart. She defied expectations, and we have a little tribute to her at the end. But markets are also defying expectations. We're seeing the stock market earning revenue projections all defy expectations, and that's something we're going to talk through today. As usual, we have our typical 5 topics: inflation, interest rates, geopolitics, equity markets, and we'll touch on other asset classes, in particular private markets, because Anastasia, obviously the Partners Group, is very much focused on private markets. And some of the discussion topics underlying what we're discussing today, we're going to really dig into the economic vibes, narratives and counter narratives that we're seeing around the world. We're going to speak on the bond side about some of the interventions and the return of debasement fears. When we move to the stock market, obviously some strong earnings news there today. We'll look also at the IPO picture and whether that's changed. And then, as I mentioned, private markets outlook. And this is Anastasia. I'll let you read that. So let's kick off, Anastasia, in terms of the economic narratives and counter narratives. Clearly, we haven't spoken as much about inflation, but it hasn't gone away. We have tariffs rearing their head again, which could be inflationary. We also have AI, possibly inflationary, very likely, but also a fueling of global growth likely to come from that. And then in terms of some of the surprises of the year, well, Europe is generally suggested as a much lower growth region than the US. We are seeing its strongest GDP growth, say in Germany, since 2022. So I'd love to get your big picture thoughts on where we are growth-wise and the role that inflation is likely to play globally.
Sure. Well, so much to unpack here, and these are all sort of, great narratives to talk about. First of all, I do think growth globally is on solid footing, and that's certainly the case in the US. As you mentioned, I would say even Europe, which has historically been a more sluggish region, I would say that's waking up too. And also this AI spillover effect is clearly impacting Asia as well. What I'm really encouraged by today, Ethan, I would say, is that we have a multi-engine growth, certainly playing out in the United States, for example. And when I look at corporations, they are growing earnings quite significantly. And yes, that's going to likely subside in 2027, but that should still subside at a level that's materially higher than sort of the long-term figures. So that's really quite encouraging. And by the way, these corporations are also looking at record net profit margins. So that's a lot that they can do with that. And, then I look to the consumer and, in the US, the consumer, I would say, is stable. Obviously there's some divergences, but what encourages me there is that we've got the unemployment rate that is somewhat stable. You've got the job creation that is running at a level that's high enough for us to actually maintain that unemployment rate. So that means consumer as well. Maybe they're not going to be as exuberant as they were some years ago. They're going to have the firepower to still spend. And then the last thing is Capex. And, to your point, Ethan, maybe this is really the most encouraging story globally is that Capex is in the US, at least, has picked up to the levels not seen since 2022. But since you did bring up Germany, I do also want to point out that we're seeing the industrial orders, the industrial strength, especially in the defense sector, really materialize in Germany as well. So in the US, I would say, yes, it's the AI momentum that's driving Capex. Some of it is, by the way, also the reindustrialization of the defense sector. And certainly Europe is just wholeheartedly focused on its defense industry and shoring that up at the benefit of the domestic supplier. So all of that to me is quite encouraging.
That's a fascinating point around defense. And I think you mentioned Germany's industrial base, and there was some pretty staggering numbers around its automobile industry, which is coming under severe pressure from China. But if they can manage to pivot to some of that into defense in terms of shoring up their industrial base, as well as then I think the startup community is even thriving in Germany, there could be a second wave. I suppose writing it off and writing the Eurozone off probably is not wise at this juncture.
Well, that's right. And I'm glad you brought up the German auto manufacturing industry. Clearly, when you look at a German car versus a Chinese vehicle, first of all, the Chinese vehicle is going to cost a fraction of what a German manufactured vehicle costs. And as a result of that, China car exports have surged, German car exports have stagnated or actually declined. So, that's why I think part of the reason why Mario Draghi came out with the report to really encourage policymakers in Europe to boost its competitiveness across a variety of industries. And I was just looking at the chart, kind of tracking the progress of the Draghi report implementation, and the sector where you do actually see the most progress is defense, as we just talked about, and energy is behind that. But I do think that Europe has a few more things going for it, especially if it does stay on this trajectory of implementing the Draghi report.
That's a fascinating point, and I think the key thing may be moving from talk to action, which is the US is very good at, and with the Draghi report. I want to move to tariffs. The chart on this page reflects the effect that tariffs are having on US agricultural exports to China. So it's really the domestic focus. But of course, they have been very strongly in the headlines. I've termed this the summer of deja vu, in that we have had tariffs really pop up again and again, and quite severely with the case of Canada, and some of the rhetoric really upping the ante there. So not only do we have Canadian trade, I think it's an interesting point that may not be well known, is that US imports more from Canada than from China. So that this is real money and real impact here, these tariffs. And then on the geopolitical side, we also have, I'd say, not the problem not going away, but also arguably getting more intense, with drones in Leipzig airport in Germany, suggesting there could be some involvement by Russia there, and Iran sanctions with China weighing in. So this geopolitical backdrop, how much attention do you think markets will pay to it? And have they just become so focused on earnings they move through?
Yeah, well, judging from this week, I guess the answer is none. But, but let's dissect why that actually is the case. First of all, I think the markets have had to come to grips with the fact that this is going to be a lot of deja vu, and likely kind of, it's not a summer, but maybe a prolonged period of stalemate. So first of all, let's talk about the trade war. And, look, countries are digging in to protect their domestic economies. And, I think most countries around the world have now sort of, come to grips with the idea that tariffs is going to be a part of the formula. And, markets have adapted to that. They have adjusted for that. And by the way, over the course of the last year, that's when we had to bake into some of those earnings expectations. So I would say a lot of the tariff noise is already baked in. The other thing I would say about tariffs in particular in Canada specifically, yes, there's a whole lot of trade that happens between the US and Canada, but when you look at some of the tariff goods in question, it's not the 460 billion or so, that we're talking about in terms of volume of imports or exports, but it's about 20 billion. So it is not the aggregate basket that is that is in question. So I think that's giving markets just a little bit of comfort there. And then going over to Iran, look, the base case had to shift, I think, for all of us, which is it's not going to be a grand bargain. It's not going to be a grand unveiling of the peace deal, but it is likely going to be a process of adjustment to the new reality, which is the Strait of Hormuz may or may not reopen. But either way, it's going to be really difficult for countries and companies to rely on reliable shipping through the strait. So therefore, they have to pivot. They have to get the production out elsewhere, whether it's through the pipelines for Saudi Arabia or Oman, whether it's building new pipelines. They have to procure resources from somewhere else. And, US clearly has been a big beneficiary of rising LNG volumes. Certain countries may have to rein in demand to sort of adjust for this new reality. But in aggregate, as we do all of that, I think that's why. Well, and by the way, some oil is actually probably still flowing through the strait, even though it's not being reported. So when you take all of those measures into account, I think that's why the markets have been able to look through it. You have to be inventive to adapt to this new geopolitical reality.
That's a great point, and we could discuss this all day, but I think we have to move to the other focus of the macro markets, which has been this bond activity. It's a little bit of old news now almost. It was more in focus last week. But I think what's really very interesting is to hear some of the pushback on what I'm terming here Bessent's big bet. He did, you could say, maybe bet against the Fed in terms of his desire to intervene in the bond markets and really focus on driving down those yields. So we've seen some of the players, so the Citadel, Druckenmiller weigh in as suggesting this is financial repression. We know that the immediate reaction was for the dollar to go lower, it's debasement concern, and the gold to go higher. And I suppose that this has been the bond market all along has been less volatile, but it has been calling perhaps some of these concerns that are not going away, whether it's around mounting fiscal deficits, or just the fact that we are kicking this can down the road. Would love to hear your thoughts on where we are today. And Jackson Hole is happening as we speak, and we'll have a big presser tomorrow.
Yeah. Well, I think Scott Bessent and Kevin Warsh are trying to solve different problems in different parts of the curve. I will say that whatever Kevin Warsh does in terms of short-term interest rates is not necessarily the determinant factor of what is happening with long-term yields. And let's call it what it is. There's a few things that are happening with long-term yields. First of all, growth is actually better than expected. It's stronger than expected. And maybe there's this AI productivity boom scenario that's also being baked into longer-term yields. So that's actually not a bad reason for why yields are rising, is because of higher growth expectations. Then there's a sticky inflation component. Fine, we're trying to fix that, obviously. But I actually do think that there are signs of easing inflation, and the long-term expectations are pretty well anchored. And then let's get to the tough part, which is the term premium. If you look at the term premium on the 10-year US Treasury, it has been rising, and well, it's been surging really. And I think it is for reasons that are fundamentally difficult to fix, as we know. It is about budget deficits. It is about the debt to GDP. It is about the fact that other foreign exchange holders are diversifying their holdings, maybe to gold, maybe to other currencies at the expense of potentially the US dollar and the US Treasury. And so, we do have to address that. And unfortunately, that's not an easy fix. It's not a quick fix. And it's certainly not a buyback fix, in my opinion. So that's why, as market participants, again, speaking of shifting base cases, the base case may have to be that even though the rates at the short end of the curve might stay anchored, that is my view, I think the rates in the long end of the curve may continue to face some of that upwards pressure.
And yeah, obviously the headlines continue, whether this is the drip US debt crisis. Another interesting beneficiary has been crypto, which is going to every stages a comeback every so often, and behaves how investors expect it to behave until it doesn't. It seems it's still not
a very good point.
Yes, it's still not an assured digital gold or other offset to currency debasement. And I think also the point around federal spending increasing, tax revenues falling, and this is, I suppose, gnawing away at market watchers and some economic purists, I suppose. It seems the answer to this is growth. And I'll move to equity markets now because that is where we're starting to see some of the growth. But I think today it's interesting that I had this slide in the book 2 days ago, and we're now seeing quite a bit of activity from Nvidia. So I suppose looking at the stock markets from 2026, I think to date, what has been important is just how Nvidia, I suppose, has lagged, but yet the leaders have really still been the tech stocks. And I suppose looking kind of big picture at equity market strength, earnings strength, tech dominance, how are you thinking about the complexion of this equity market, and even globally? How do you think about the complexion of the strength we're seeing?
Yeah. Well, much like the multi-engine economy that I described, I think that portends very well for the equity markets. Yes, I'm certainly encouraged to see the continuation of the AI momentum, and I'll touch on that in just a minute. But the fact that you've got industrials doing well, the fact that you've got the capital markets activity doing well, lending growth is actually picking up, so that benefits financials. The fact that you have consumer hanging in there and still spending, even though consumer discretionary stocks have lagged, I still think that's a fine environment for consumers. So the point is, I like the composition of this equity market and the participation that's coming from more than just tech. Having said that, when you have the AI trade and anything that's AI adjacent kind of comprises close to 50% of the S&P, you've got to have that part do well. And clearly, we've seen that with NVIDIA. We've seen that with the broader tech story. And I think it's for the right reasons. Look, we very closely track the AI momentum in terms of adoption, in terms of innovation, in terms of monetization. And I would say we're seeing all of those things progress in the right direction. Adoption wise, you've got 56% of US enterprises that pay for some sort of an AI tool, and that number continues to move higher. You've got 43% of workers in the US that use some of those AI tools. I will note that Europe is lagging somewhat, probably with a 30%, 32% adoption rate for select countries. But either way, the adoption is rising and rising pretty sharply. The second thing that's really accelerating is innovation. And look, we've seen by far, by a factor of something like 3 or 4 times, the greatest number of AI tools and plugins launched this year. And so all the spend that's going on innovation is paying off. We're seeing more and more capabilities. And we're also seeing those capabilities from many more competitors. And therefore, some of those capabilities are becoming cheaper. All of that, by the way, drives adoption as well. And then the last thing that really does encourage me, and I think it's encouraging to the market, is that we're seeing monetization. NVIDIA, case in point, guiding very solidly for 2028 revenue projection, but it could be NVIDIA, it could be the memory chip stock, it could be a hyperscaler, it could be a networking provider. All of those parts of the AI ecosystem build out are actually seeing their revenues and earnings accelerate. So as long as that's the case, that should continue to support this big chunk of the S&P. But again, having said that, it's nice that this is not a 2023, 24 environment anymore. This is truly an economy that is much more solid and supportive of the broader market.
Yeah, that's a great point. And there are some other, obviously, there is a winner and loser phenomenon here. But some of the software valuations, it's unfortunately frozen as of 2 days ago, and we've already seen a pretty solid turnaround in Salesforce, say, for example, today. To me, this illustrates another point about markets, which is just how volatile individual stocks can be. There's quite of a sentiment can swing quite radically once there is a suggestion maybe that something's not out of favor. That's something that I'd suggest investors need to just have a stronger stomach for, in that there is going to be single stock volatility in those names. I bring it now to your industry specialty around private markets, and given that we saw Workday on even a report of a takeover by Silver Lake having its best day in 10 years. So clearly quite a bit of interest still there in some of the software stocks. Any thoughts just on the winners and losers point before we move on to discuss private markets?
Yeah, definitely. Well, I will tell you, at Partners Group, we've sort of minimized our software exposure and tech exposure, given where the valuations were prior to this year. But, given where valuations are this year, especially post the sell-off that we saw in the first quarter, we are a lot more interested in looking at some of those opportunities. And, from a kind of an investment strategy perspective, I will say, the knee-jerk reaction, the death of software narrative, our opinion has been greatly exaggerated, and it's such more nuanced and so much more complex than that. And what I mean by that is, first of all, if you're a software company, especially a successful one, you're not sitting there waiting for AI to come for you. You're not sitting there waiting for agentic capabilities to take off. You are actively, most likely, embedding some of those into your own business. And so just because you're a software incumbent, it doesn't mean you're going to fall by the wayside, because if you can successfully re-engineer with those agentic capabilities, you might actually still be a very successful leader down the road. So that's kind of the first thing to recognize. And then, if I look at the software reporting season that just finished up, it's actually been quite strong. And earnings for software companies are running at around 20% year over year. You look at gross margins, they're somewhere around 75%. So that's a lot of firepower to try to keep up in this AI world. And then the last thing I would say, look, being realistic, some software companies will not be here, 5, 7 years down the road, or maybe sooner than that. And so you do have to dissect softwares, what is at risk, what has a strong technical moat, what has a strong non-technical moat, what doesn't. And that's a very active approach that we take to evaluating any sort of software or tech opportunity these days.
And it's fascinating. And I'd like to move on to the IPO point because we are seeing nonstop, I suppose, chatter around the Anthropic, OpenAI. We're still digesting the fallout from SpaceX, where it seems to be more stable today. But certainly we had to navigate, I think, a fairly unusual situation, not only because of the unprecedented size, but also the unprecedented percentage, perhaps, of the business case there that was quite speculative and really far into the future.
Yeah.
Unproven, unmodelable, and really a lot of a bet on a single individual. And we now have some from consumer brands, whether it's the Aura Ring or the brand company behind the Dunkin', well-known Dunkin' coffee, getting ready to join its IPO. Somewhat different dimensions, I would suggest, in play there with respect to these brands. We've also seen Shein with its $27 billion IPO in Hong Kong, a fraction of where it would have been 4 years ago. Suggestion here that there was a golden time to list and they missed it. And clearly Anthropic and OpenAI will be very focused on finding their golden time to list. And they will probably not list at the same time. So it's unlikely that both times will be golden. How much does this IPO frenzy, I suppose, tell you about the strength of markets and investor appetite? And any thoughts on these two big ones on the horizon?
Yeah. Well, I mean, the time for IPOs is now, right? The window is open. It's been open for some time, and I think many companies are looking to seize on it. And when I sort of think about the IPO barometer, what makes it such a good time is, first of all, look at the public market valuations and the multiples that you're getting for not only S&P 500 companies, but especially the tech and growth companies. Of course, as a private market company, you want to try and get that step up and realize that. You also do have just more certainty about the direction of the economy and the businesses. And I would say business confidence is a big factor in, what makes someone want to tap into the IPO market. And then the last thing I would say is the rates and the impact on valuations. We have had some rate uncertainty as of late. But again, actually, I do think inflation is coming down and we are seeing signs of easing. And, the markets maybe, depending on the day, are pricing in a rate hike or two. I don't actually think we get that. But long story short is credit costs or rates have come down significantly from where they were in 2022. So all of this together makes it a pretty compelling window to list. And as you know, companies have stayed private for longer. And also a lot of managers have allocated capital, several years ago and have elongated the time that they typically, or they hold a company versus what's normal. So all of that is sort of colliding together and making this such an attractive time. Now, the other point, even on, the two upcoming big IPOs, and I'm not talking specifically about, OpenAI, Anthropic, it's not really expressing views on those, but I will say, so much value gets generated in private markets while companies stay private. And, if I look at the IPO performance versus when a stock or a company was private. So if you had invested while the company was still private, somewhere between Series A and Series E round, the average return, if you held the stock 6 months after the IPO, would have been something like 70% annualized. If you invested at, let's say, the IPO price or the preferential price, maybe that return comes down to, call it, 40% or so. But if you invested had the market open, that return comes down significantly 6 months after. So I would just have a degree of caution. To your point, there's a lot of enthusiasm that is baked into to some of today's largest quasi-public companies, and I would just have a degree of caution of what is priced in near term.
That's
Is
a
it
great
too
point.
much?
That's a great point, and we'll discuss in a second just how private markets are faring right now. Again, the rumors of their demise may have been exaggerated. But I think just to bring up one point, which actually there's a headline here I have regarding NVIDIA, because the key thing of being an entry, say buying day one of an IPO or even buying a stock, is obviously doing due diligence as to what exactly you're buying. What is this? What sector is this company in? What multiple should it be commanding? And we have seen quite a bit of shape shifting in one direction, certainly around AI becoming companies taking on the AI mantle and trying to change their stripes in that case. We saw that with a sneaker company, Allbirds. We've seen it before with blockchain, back in the day. And those type of shape shifting, we would suggest is probably opportunistic, and you could be cynical about it. But it has certainly seen a return of momentum for some of those stocks. This NVIDIA activity, I think, is another fascinating form of shape shifting. Is NVIDIA becoming essentially a financial company? Clearly, it has a strong tech bent, but as it becomes a banker or a provider of finance to its own customers, will it become so embroiled in the circular financing concept that we are seeing that it changes its shape? And I suppose that this is really a broader question too about circular financing. Do we
Yeah.
really understand these cross exposures? And do we really understand what we're buying with any particular stock?
Yeah, the answer is maybe, but do we understand enough, or do we map it out on the aggregate level? The answer is probably no, not yet. But that's exactly the exercise that we need to go through as investors, is to start aggregating all of these numbers of leverage that are popping up in a lot of places, whether it's the hyperscaler debt, whether it's the asset-backed debt by some of these semiconductor chips, whether it's data center debt. We do have to make sure that that doesn't get out of proportion to what the opportunity is. So it's not to say that today, this is an immensely risky proposition, because as I mentioned, the AI momentum is ongoing, the revenues and the earnings growth for NVIDIA and NVIDIA's sort of partners is ongoing. So at the moment, it is not a risk. But I would say the biggest risk to all of this is what if we have a technological breakthrough that maybe doesn't require as many semiconductor chips, or maybe it doesn't require the latest generation chip for everything, or maybe some other form of AI gets adopted, or maybe we don't need as much data center capacity. So, I see the biggest risk to this, like it is with any market, is when leverage is being built up and you have a catalyst that fundamentally changes the trajectory of the trade. I mean, let's say the housing market back in 2008, then that's when leverage becomes a extremely risky proposition. So it's not to say today is the reason to not invest or to avoid the opportunity, but I think it's something to be paying very, very close attention to over the coming years.
And I think investors are, and that gives me a lot of assurance in that we are constantly looking for that next trigger based on our pattern recognition from previous crashes. And I think it's natural that 9 out of 10 of these triggers will not transpire. But it's important to keep looking for them, and maybe if you look around the corner for the frailties. Last point here is on private equity update, and would love to just get sorry, Dolly Parton's quote has crept into that, but it shouldn't have. But we'll talk about her in a second. But the private equity growing, attracting record first half inflows, the sector rebounding. We're seeing this. Private equity fundraising year on year. For the half year, it seems to be very robust. What would you say in terms of what you're seeing from your angle? Is this just more of the same, that we've had our eye off the ball in terms of the private equity being solid as ever? And what's driving some of this rebound?
Yeah. I mean, I think private markets earlier this year have been sort of caught in this, negative loop of worries about software, then software in private credit, then worries about private credit. But the reality is, when I look at the private markets environment today, private equity specifically, first of all, it is priced at a much lower multiple than you actually see in public markets. So if you're worried about the S&P valuations, if you look at EV to EBITDA for, let's say, buyout private equity, it is at a 3.5, multiple discount to what you see in public markets. And by the way, that is the lowest level, though, or that is the greatest discount in about 15 years. So you have an attractive entry point. And then when you look at the growth of sort of the existing portfolio companies, that growth rate is accelerating, and also just much like we talked about the S&P earnings or the Mag 7 earnings. Again, you're seeing that acceleration in private market companies as well. And then I would say, look, I think one of the most underappreciated and not yet priced in opportunities in AI is actually embedding AI capabilities into portfolio companies. And, private equity industry is certainly focused on it. We are certainly focused on it. And if I look across the industry, somewhere between 50 and 70% of portfolio companies, VC backed or PE backed, have AI initiatives associated with them. And that could be the engine to value creation that I think is getting some investors excited. For us, at Partners Group, I will say we have 90% of our portfolio companies have AI initiatives associated with them, and they're scaling, and the EBITDA uplift, the profitability uplift that's associated with them is scaling too. So that to me is yet to be priced in. But I think, back to this kind of headline is the valuations, it's the economy, it's the opportunity to create value in some of these middle market portfolio companies with AI that's really quite compelling to investors.
And I think the key thing is the stewardship that comes from a private equity expert in that respect, because there is a suggestion that there's the reason why larger companies have really taken this AI and run with it initially, and this mid-cap companies have trailed, is just a question of expertise and scale and ability to spend and train staff. I think we see
Yeah.
some initiatives around the large private equity companies combining with some of the frontier model companies to actually launch these consulting arms. So clearly a desire to lean in with some of this expertise. Maybe also there's a portfolio construction issue around just rebalancing with public equities doing so well, then desire not to sacrifice growth, but also maintain growth of a different kind, perhaps at a different stage and certainly marked differently. I see that from an institutional standpoint as still a
That's
desire
right.
to really top up some of the private equity. Well, thank you so much, Anastasia. I will now finally turn to our last tribute of the day. Clearly, we lost Dolly Parton this week. I think an extraordinary figure as a philanthropist and as someone very true to who she was. So I thought that quote about finding out who you are and do it on purpose, I thought was a fantastic reminder to all of us in the industry. You, of course, a complete pro when it comes to commentary like this. It was a delight to have you all to myself for half an hour instead of just for
Thanks so
7
much.
minutes on watching you on Bloomberg or Fox. For me, getting to ask the questions, what was a true treat. So thank you so much for coming here and for sharing your insights with us.
Thanks so much, Ifan. It was a pleasure.
Aoife and Devitt, thank you for listening to the Markets Happy Hour podcast.